Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. US markets, of course, back today from their long weekend. An interesting session so far, really. Early losses for the FTSE 100 being reversed. European markets beginning to pick up as US futures start to wake up after a fairly soporific day yesterday, as is always the case, really, when US markets are on holiday. Not too much to report overnight, although the RBA left rates unchanged as expected. Central banks really shifting to a wait and see mode, it seems. And certainly that's what we expect as well from the Bank of Canada tomorrow. So that makes two important central banks who will be leaving rates unchanged, which sets the mood music as we debate what the Fed will do next. In the wake, particularly of last week's jobs data from the US, not just Friday's payrolls, but the job openings, the ADP numbers. The payrolls, of course, showing a rise in unemployment rate as well. So giving the Fed maybe some more cover, if you like, for not moving on rates. Although, as we'll see in a while, with oil prices continuing to rise, there is still a risk that inflation will come back to haunt us in the final months of this year. Aside from that, you had a China services number, which was also growing at a weaker pace, at its weakest pace in 8 months. So nothing too cheery there. Did knock the Hang Seng quite a bit after its recovery yesterday. Well, there are signs maybe of a calming of tensions in Chinese markets with the latest property crisis, if you will, just beginning to ease a little. Otherwise, it's a fairly quiet day overall, really. US markets is getting back into the swing of things. Not much in the way of major earnings, and indeed just factory orders from the US later this afternoon. So markets continuing mainly to focus on what the Fed will do next, really. Starting with the indices, beginning with the FTSE 100, which currently trades at around about 74.60 in early morning trading, having dipped, as you can see, from this candle below 7,400, taking it to its lowest level in about a week there. And it did look as if we were having the makings of a lower high for this really significant pressure on the index and conforming to this continued downward pattern that we've seen since the beginning of August, which has really meant the FTSE's been left out of any general bullishness. European markets are mostly okay. US markets and the Nikkei have done particularly well. But for FTSE, it's been a miserable month. The strengthening dollar playing a part there, really. But if we can see a close above 7,400, if we can avoid a lower close today, and ideally with a bit more upside, perhaps back towards 7,500 today or in coming days, maybe there'll be hope that the buyers can arrest this decline and that this double dip into the 72.50 zone will then mark the low for the time being. So the next thing to watch for towards the outside, 7,600, the initial highs from the first half of August, and then on to the late July highs around 7,700. We can get back above there. There'll be hope maybe that with the price then back above the 20-day moving average, that there'll actually be a recovery here in the index over the medium term. Maybe we can finally put the weakness of the past 6 or so months now behind us. If you remember, the FTSE 100 hit that 8,044 level in February, and then has been able to recover those glories since then. But as I say, the dip into 72.50, which mirrors what we saw in March around the banking crisis, that this area found buyers around 7,300. If it can hold above that, maybe they can see a broader hope for further upside heading into the end of the year. To the DAX, and this market, of course, hasn't gone down, but hasn't gone up either, really, on any sustained basis since the beginning of April. Yes, we did see that record high right at the end of July, just squeezing in some positivity before the August slump, which we duly got 1,000 points or so knocked off the index. But sellers weren't able to drive this one much lower, and certainly weren't able to push it back below the 200-day moving average, which I think is significant, really. The fact that buyers couldn't hold it at the highs, but the sellers couldn't equally push it lower, certainly below those July lows. It's a sign that there is some willingness to push this one higher, maybe over the medium term. We're just waiting for the positive news. The fact the ECB is fretting about stagflation in the European economy, of course, not helping. But overall, the fact it's stopped going down, it's not continued to breach those lows from July and August, is a relatively strong sign for the buyers. We're just waiting now for the positive catalyst. And for that to happen, you need, again, what we said it before, umpteen times since May, that move back above 16,000. If we can hold above that now, which has been a singularly interesting thing, that we continue to try and move above 16,000, but after a day or so or a week or so, it drops back again. And that's what it needs to do, is stay above 16,000 and then it's within a chance of moving back on towards these highs from the actual summer of June and July, really, and then on from there. The fact we are still just a month or so away from that record high is still a fairly bullish sign, it has to be said. Unsurprisingly, the index mostly in consolidation mode after this huge rally, where we were almost a year ago now, down at 12,000. That's perhaps not surprising. A lot of the good news is, or certainly less bad news, has now been priced in. It's just that we need the next catalyst to drive us higher from that. And for the moment, that is just lacking, as is the price catalyst. But the lack of any drop below 15,500 continues to give strength to at least a medium-term bullish argument. US markets, of course, back from their long weekend. The Dow, after a little bit of a wobble below the 50-day moving average this morning, Dow, the cash market itself, or the IG market, the IG cash market, back above the 50-day, no doubt eyeing up a move back above 35,000 to clear the way back to these late July highs, 600 points higher from there. And if that happens, of course, that puts further strength into the uptrend, and then allows the Dow to move into the kind of territory that we last saw at the beginning of 2022, around 35,900, perhaps even higher than that into the medium term. Maybe by the end of the year, if you wanted to be optimistic. Certainly the other indices have done better than in the US. The Dow seems to be finally playing catch up. One interesting thing is that because of the way the Dow is constructed, energy stocks are more important in this index than they are in some of the others. So with the recent strength in oil, that has given the Dow a bit of a lift and helped it, really in some ways, to do better than the Nasdaq. But this is more a case of the index playing catch up. But so long as you hold above 34,500, you can arguably maintain the bullish view into the rest of September and beyond. Looking at FX markets, it's the strengthening dollar that is providing a lot of interest at the moment. And that, of course, is putting plenty of pressure on the euro and on sterling, as we'll see. A euro dollar slipping to its lowest level this morning since June. Really beginning to look like that this uptrend has certainly run its course for the time being. I think it is still just about in, I suppose, pullback uptrend territory, but it's looking very, very shaky. The fact that we couldn't hold above these early July lows was a sign. We're now below the 200-day moving average for the first time since November. So the euro's impressive rally against the dollar seems to have run its course for the time being. The next target being this big support level from May and June around the 106.70 level. If it gets back below there, if it breaks that, then that adds more to the bearish view as well. The fact that last week's bounce as well ran out of steam at 109.30 and at the 100-day moving average is another sign that maybe the buyers don't have quite the power they used to in this one, and that we're seeing a resurgence of the US dollar. So until we see a move back above 109.40, it's hard to muster a particularly bullish view on this one either. The same thing for the pound, maybe still clinging on more to its uptrend. But if this dollar has further to run, and this I think is being driven not because we think the Fed will hike again, but more because prospects are so much else of the global economy. It looks miserable. Stagflation being raised as a possibility in Europe, which isn't great. The UK economy doing better than we thought, thanks to those ONS revisions last week, but still not spectacular. So it's more a case of people buying the US for the strength rather than because they think the Fed will keep hiking. So the fact that the pound hasn't been able to hold 126, it's slipping down inexorably, it seems, towards that 200-day moving average, puts additional pressure on it, really, and just dents the uptrend. Certainly, it doesn't mean it can't recover. Maybe some good UK data might change that, but we'd have to see that move back above 126.70, above 127 to really make people more comfortable. We find ourselves in a bit of a no man's land for the uptrend because we're below the 50 and 100-day moving averages, but above the 200. If we were still, as we saw in May and June, above the 200 and the 100-day, that's more of a safe uptrend call. I think at the moment we're moving into neutral territory here, which is going to be quite tough. Could lead to choppiness, really, particularly around that 200-day moving average. A dollar yen, unsurprisingly, back not quite at the highs we saw last week, but certainly very close to it. Last week's high 147.37.8. We find ourselves at 147.07.6. So just a whisker away, really, with the uptrend hitting a new higher high, and that then leaves us the next big goal. You have some intermediate, perhaps resistance around 149, but then above that, 21st of October, 151.94, the highest level for almost a year now. And this is definitely an uptrend, and this is probably a sign of interesting how uptrends sort of fade and then suddenly come back again, which is maybe what the euro dollar and sterling bulls are hoping for at this point. Dollar yen slowly clawing its way higher since January, sort of cancelling out the negative impression, because you could have argued this to be a lower high here. You certainly justified that view, but then it cancelled that out and shifted to bullish, really, as we said. Golden cross in June, nice pullback towards support, and then off it goes from there. So the bulls firmly in charge in this one as well, and no sign they're about to let go in the medium term. And then we go towards commodity prices. Unsurprisingly, stronger dollar does no favors for gold, which really just continues to build this view that we're heading lower, really. After the failure of the July bounce, we dropped down all the way through August. We dropped back below the 200-day moving average again for the first time since last year. And now, just to pile on the woes for gold longs, you've seen this price rally towards 1950, falter below the 100-day moving average, and it's dropping lower once again today. So there's going to need to be some pretty heroic buying to get this one back above 1950 and really cancel out this looming bearish view. I think at the moment it probably still just about falls into the neutral camp here, but a drop back below 1900 would add to the bearish view and then bring this low from August into play, and then potentially from there as well, because this is a lower high. It does look fairly miserable at the moment, and I think you've got to be fairly careful about taking an optimistic view in gold with the dollar continuing to strengthen. And then crude oil, which shows no sign of heading lower in any meaningful way. It's drifted for the second day, unsurprisingly, given yesterday was a US holiday, but market's still sitting comfortably at this highest level again. Bit of a broken record day, highest level today for oil as well since November of last year. And that, I think, is because we see signs of hope in China, with maybe some stimulus measures will bear fruit in time. There's still no sign of global recession. We're not saying one can't arrive, but the fact that it's noted this morning Goldman Sachs has downgraded its expectations of a recession 15%. How they work that out, don't ask me. But nonetheless, they have, and that the corollary of that means they expect stronger oil demand. So that's put the price on the front foot once again. So while it just consolidates, just edges lower a bit, the bullish view still firmly in place here overall, I think. As ever, here's your golden cross. So any weakness in the short term here back towards 80 could still see buyers emerge. And again, downtrend of the past year or so seems to have run its course for the time being. With the moving averages turning higher, we're now shifting from those buy dip kind of movements on the daily chart with weakness. Looks to me more of an opportunity to go long rather than an expectation of further bearish price action. Back below 78.30 or so, and maybe we'll change that view to a more neutral one. But at the moment, the buyers in the medium term still have the upper. So to the rest of the day, of course, US cash markets back again as normal at 2:30, expecting the Dow to open the day around about 34,830, and that marks a gain of about 30 points or so. Loss down from about 7 points from Friday's close. So nothing too spectacular on the open. As I say, not a busy day, just US factory orders. So nothing particularly in the headline news to drive it. We'll see whether the dollar continues to strengthen, where that again puts more pressure on gold prices. So that's it for me. Thank you for joining us. We will see you again tomorrow at 10:30.